All right, let's get right into it. Today we're talking about a huge shift in how we need to think about money, about wealth, and especially about retirement. It's really a journey from that old school advice of, save every penny, to a totally new way of thinking. One that's all about building a fortress of real, tangible assets to protect your future.
So, let me kick things off with a question that might sound a little bit nuts at first. Is the money you're so carefully stashing away in a savings account actually making you poorer every single day? I know, it's a wild thought, but it is at the absolute heart of what we need to understand about the financial world we live in today.
And that leads us to this quote, one that just turns everything we've been taught about money completely on its head. Savers lose, debtors win. Now, for most of us, it sounds totally backward, right? We're always told that saving is good and debt is bad. But we are about to break down exactly why, in today's economy, that statement is shockingly true.
So here's our game plan for how we're going to get there. First, we'll unpack the huge problem every saver is facing right now. Then, we're going to totally redefine what a real asset is and dive into the incredible power of cash flow. After that, we'll look through the two critical lenses every investor needs, we'll re-examine debt not as a trap but as a powerful tool, and then we'll pull it all together into a blueprint for your own financial fortress.
Okay, so first up, the saver's dilemma. For generations, we've heard it all. A penny saved is a penny earned. Cash is king. But we're about to see why holding on to cash might actually be one of the riskiest things you can do with your money.
To get this, we have to start with what our money even is. You see, before 1971, the US dollar was actually backed by gold. You could literally walk into a bank and exchange your paper dollars for a set amount of gold. But that's not the world we live in anymore. Since then, it's become what's called fiat money. And all that fancy term means is that it has value simply because the government says it does, and we all agree to trust them. It's not a claim on a thing, like gold, it's a claim on a promise. And here's the kicker. Central banks can print more of it whenever they want, which means that promise is constantly being watered down.
And this right here, this is where the rubber meets the road. This is the inflation sting. Just look at the brutal math. Let's say your savings account is paying you, and this is being generous, less than 1% interest. But at the exact same time, the official inflation rate is, say, 3.6%. This means your money isn't growing, it's shrinking. You are losing over 2.5% of your actual buying power every single year just by letting it sit in a place you thought was safe.
So here's the key takeaway, and it's so important. You look at your bank statement and you see the same number of dollars. You have the same amount of currency, but you do not have the same amount of wealth. Wealth isn't just the number, it's what that number can actually buy you. And if your dollar buys you less gas, less food, less of everything than it did last year, you've gotten poorer, period, even if the number in your account never changed. And this is exactly why savers lose and debtors win. Let's paint the picture. The saver puts their dollar in the bank, and inflation just silently eats away at its value. But look at the debtor. They borrow $100,000 today. Now that debt is fixed. It's $100,000. It doesn't go up with inflation. So they get to pay back that fixed amount years from now using dollars that are worth less and are way easier to come by. They're literally paying back a huge loan with cheaper money. It's like getting a secret discount from inflation itself.
Now, to take this idea to its most extreme, just imagine this scenario for a second. Think about hyperinflation, where paper money is so worthless it's like leaves blowing in the street. You could sell one banana, just one, for $100,000, and then you could take the money from that one banana and pay off your entire mortgage. A mortgage you took out years ago. It's a crazy thought, but it is the ultimate illustration of how inflation absolutely destroys savers, but can create a massive windfall for people holding long-term, fixed-rate debt.
Okay, so if saving paper money is a losing game, then what in the world is the alternative? Well, that brings us right to our next section. We need to redefine what a real asset even is. See, the wealthy don't pile up stacks of cash. They accumulate assets. But I guarantee you their definition of an asset is very different from what you and I were taught.
Robert Kiyosaki, the author, gave us the simplest, most powerful definition you'll ever hear. And it's this. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. That's it. It's that simple. It doesn't matter what anyone else calls it. Just ask yourself, does this thing make me money or does it cost me money?
So, let's put this new rule to the test with the biggest purchase most of us will ever make. Your home, the place you live. Is it an asset? Well, if we're being honest and using this definition, for most people, the answer is a hard no. Why? Because every single month it takes money out of your pocket. You've got the mortgage, property taxes, insurance, upkeep, repairs. It's a constant drain. It's a liability.
So what does a real asset look like then? Well, we're talking about things like a business that runs without you having to be there every day. We're talking about stocks that pay you dividends, your share of the profits. We're definitely talking about income-generating real estate, like a rental property where your tenant's rent covers the mortgage and all the bills and still leaves you with a profit. It could even be royalties from a book or a song you wrote. You see the common thread here? All of these things put money in your pocket, month after month, year after year.
And this focus on income brings us to the real engine of wealth creation, and that is cash flow. This is the key, you guys. This is what unlocks the door to retirement and real financial freedom. It's about shifting your entire focus away from just watching your net worth bounce around and onto building a reliable, steady stream of income.
You know, there's a massive difference between how amateur investors think and how the pros think. Amateurs are obsessed with capital gains, buy low, sell high. Their whole financial life is tied to a net worth that goes up and down like a roller coaster. It is super stressful. Professionals, on the other hand, they focus on cash flow. They build a machine of assets that spits out consistent, predictable income every single month, whether the stock market is crashing or soaring. Because here's the truth, net worth doesn't pay your electric bill. Cash flow does.
And, Warren Buffett really just summed this whole thing up perfectly. The goal isn't just to work for money your whole life. The goal is to get your money, your assets, to start working for you. Building those streams of cash flow, that passive income, that's how you make money while you're sleeping. It is the only way to finally break free and achieve true financial freedom.
So how do you actually build this? Well, you create what I like to call a cash flow compounding machine. It's awesome, and it's simple. Here's how it works. Step 1. You get your first income-producing asset. Let's say it's a small rental property. Step 2. You take the profit, the cash flow from that property each month, and you save it. Step 3. Once you've saved up enough from that first asset, you use it as a down payment to buy your next asset. And now you have 2 assets pumping out cash. You just rinse and repeat, and the growth just starts to snowball. It becomes exponential. That's the magic right there.
Now, buying assets sounds great, but how do you know which ones to buy and when is the right time? Well, that requires a proper toolkit. So in this section, we're going to look at the 2 essential lenses every single investor needs to use to get the full picture. It really just boils down to answering 2 super critical questions. What is a good asset to buy, and when is the right time to buy it? Because if you get the what right but the when wrong, you could end up overpaying. And getting the when right for a terrible asset, well, that's just a waste of time. You have to have both.
The first lens is what we call fundamental analysis. Think of this as putting on your detective hat. This answers the what to buy question. If you're looking at a stock, you're digging into the company's books, their profits, their sales, their debt. You're looking at who's running the company. If it's a piece of real estate, you're running the numbers on the potential rental income and expenses. It's all about finding a healthy, quality asset that's truly worth owning.
But finding a great asset isn't enough. You need the second lens, technical analysis. This answers the all-important when to buy question. This is more about studying market psychology by looking at price charts and trends. Is the market going up or down? Is the specific asset you want showing signs of strength or weakness right now? It's about timing your entry so you don't accidentally buy at the very top of a bubble. You use both of these together, fundamentals to find the gems and technicals to time your purchase, and you have a massive advantage.
Okay, let's talk about the big scary one, debt. Most of us are taught to see debt as a trap, something you have to avoid at all costs. But what if it could also be one of the most powerful tools you have for building wealth? The secret is understanding there are 2 totally different kinds of debt. First, you have bad debt. This is what most people are stuck in. It's using your credit card for a vacation or taking out a big loan for a fancy car that loses value the second you drive it off the lot. It's debt you use to buy liabilities, and it makes you poorer. But then there's good debt. Good debt is when you borrow money to buy an asset that produces cash flow. The classic example is getting a mortgage for a rental property. You use the bank's money to buy the asset, and then the asset's income, the rent, pays off the debt for you. This kind of debt actually makes you richer.
All right, let's bring this all home. We have torn down the myths about saving. We've redefined what an asset is, and we've talked about the power of cash flow and using debt as a tool. Now, let's put all those pieces together into a final blueprint for building your very own financial fortress.
Here it is, your new financial blueprint. Let's run through these one more time. Number 1, stop making saving paper money the goal. Start turning that currency into real income-producing assets. 2, never forget the new definition. A true asset is something that puts money in your pocket.
3. Shift your focus. Stop stressing about your net worth and start methodically building streams of cash flow. 4. Use your two lenses. Fundamental analysis tells you what to buy, technical analysis tells you when. 5. Learn the difference between good debt and bad debt and start using good debt as a way to accelerate your wealth building. And maybe the most important rule of all, your financial education is and always will be your single greatest asset. Keep learning.
And that all brings us to the final and really the most important question. Because this stuff isn't just theory, it's about taking action. So my question to you is this. What is the first, small, tangible step that you are going to take this week to start building your asset column?